Well, we're about midway into the AGM season here, and an interesting development ahead of rail freight company Aurizon's meeting tomorrow, with reports that Chairman John Prescott is under pressure to resign over executive remuneration issues. That old chestnut. Well, I'm joined in the studio by Fund Manager Roger Montgomery. Roger, welcome.
Thank you again, Ticky.
All right, Aurizon, this executive pay issue has been brewing for a while, because I noticed that proxy advisor ISS brought it up last month.
I personally don't mind if a company has a $10 billion market capitalisation and the CEO is being paid $6 million. That seems about right. But where I have an issue is where incentives are aligned with, for example, let's say earnings per share. Now, what that means is that a company or the management of a company doesn't have to really make great inroads into improving the overall performance of the business. But all they have to do is use company funds or borrowed funds to buy back shares and to boost the earnings per share.
You're reducing the denominator.
You're reducing the denominator of the formula, exactly. And as a result, you can get quite marked improvements in your earnings per share number. So in the case of Aurizon, in 2012, the normalised net profit after tax was $421 million. In 2013, it was $490 million. So it was up 16%. But they reduced the number of shares from 2.4 billion to about 2.1 billion, which meant the earnings per share went up 33%. And so on that basis, and the problem that I've got is that you really, once management gets a taste of how much money they can make from playing this game, then really the focus isn't on improving the performance of the business. There's a very real risk that it's just on improving their own bottom line. And when I look at the numbers for Aurizon for the last 2 or 3 years, and what I find is that something we call a funding gap. It basically means once you take the cash flow from operations, you subtract any investment that they've made, so money they've used for investing, subtract any dividends that they've paid. If there's a gap, if there's a negative number after all of that, they either have to raise capital, borrow money, or dip into their bank account. And in this case, they've borrowed money, about $1.3 billion. So you could argue it was for the investment, but you could also argue that it was to buy back the shares that boosted potentially the long-term incentives.
It's quite a significant lift in Lance Hockridge's, the CEO's pay package has gone up 30% to $6 million. I'm
not quite sure why this has become such a big issue for the Australian Shareholders Association, because there are many other examples in Australia where I think it's much more obvious and evident that the company has no prospect of improving. At least here they've made some investments in the business and improving the performance of the business, and we might see that down the track. The risk, of course, is that management is gone by the time shareholders have found out whether it worked or not.
All right, let me move to a very interesting little story that's been running in the Fairfax papers. And this is about this industry super fund online magazine, which is launching tomorrow, The New Daily.
Yes. I think this is a fantastic example of the problem that faces traditional media in Australia. And what we've got is we've got this linear mindset, particularly in the press, and they're suffering from what I call the peril of falling for the legacy business.
But it might conflict with even your online operation as well.
Not at all.
You're all fighting for the investment dollar, aren't you?
Well, no. Look, I believe that what newspapers need to do is that they need to become niche. They've got the old legacy business, which may not become extinct. It's the dinosaur, but it may not become extinct. What they need to do now is they need to actually focus on the digital era of abundance, and that doesn't mean thinking linearly. What they actually have to do is they have to actually reduce the cost of content. And the only way you can do that is by involving the community and it's specialise. You have to absolutely specialise.
But how specialised? Because here we've got, 5 million super fund members. That's what this sort of general, they're going to use content from, including the ABC. They're going to use Gary Weaven. He's an ex-union man, of course. And he says that if there's a stuff up in the industry super funds area, that'll be aired in their paper if appropriate, hopefully by a story broken by the ABC. But will it? I mean, is it likely to be independent?
Well, I wonder whether or not, and I thought about this on the way here tonight. I do wonder whether or not this is the start of, the sort of a reprivatisation of media where industry interests actually produce their own content. But you know what? When really good quality content is just a click away, the old model's not going to work. So whether this is the right model going forward or not, I don't know. Time will tell. But it's certainly, I think, an improvement on the old legacy model.
Well, we'll have to come back and see if you're right on that one, Roger
Well,
Montgomery.
it'll be a couple of years, so we'll have to have long memories.
Thank you very much for joining us.